markets. How is it looking like today? What is the Shakes Nifty doing?
Good morning to you, Winnie, and good morning, everyone. Now, the US handover doesn't look very good. I mean, the banking sector really weighed down the US markets. Yesterday, we did see Federal Bank, come out with its results, and stocks slid after the First Republic Bank's earning reignited concerns about the broader sector. Now, shares of First Republic Bank tumbled more than 49% after the regional bank posted its latest quarterly results, saying that deposits dropped 40% to $104 billion in the first quarter, but have since then stabilized. But it weighed down on the markets, and the Dow Jones Industrial Average fell 344 points. The S&P 500 finished 1.5% lower, and the tech-heavy Nasdaq Composite dropped 1.9% in trade. Now, Microsoft and Alphabet also reported their numbers, but they posted their numbers after the bell, and these are the first of the multiple big tech names on the earnings schedule for this week. But Alphabet reported revenue and earnings for the first quarter that topped the estimates. The company also said that its board authorized a $70 billion share buyback, whereas Microsoft surpassed all the expectations on the top and bottom line and beat the estimates on quarterly revenue guidance. Now, Pepsico also reported its numbers. The share rose after strong earnings and upbeat outlook. So these were the important numbers that came out of the US markets yesterday. Even though they were very good numbers, some came post the market close. But largely, it was basically the banking stocks, like I mentioned, the First Republic Bank, that really weighed down the US markets. Also, the GDP update is expected on Thursday, while the personal consumption expenditure is due on Friday for the US markets. Let's look at the European markets. European stocks also fell yesterday after several sessions of muted trade. The Pan-European Stock 600 index closed the day down 0.4%, with most of the sectors finishing in the red. FTSE was down 0.2%, and CAC was down more than 0.5%. DAX, however, was largely flat in trade, ended the day in the green, up 0.05%. That's the global handover from US and Europe markets, Winnie.
Absolutely, but let's move on and just get in a check of what the crude is doing as well. And seems like, the oil prices are a bit steady and just treating the waters with the losses. Now, inventory, when you look at it, the US inventories are shrinking. There's signs of shrinkage coming in there as well. So, which is a bit of a concern over the slowing economic growth this year, which has triggered sharp losses that we already saw for the Brent crude oil prices. In the overnight session, what we saw is that the Brent crude oil futures actually fell more than 2% in trade as well. As of now, when you look at the open, it's opened up almost flattish, just a slight bit of a negative bias for the Brent crude oil prices. But yes, they're trading near the $80 per barrel mark, and that's the lowest levels currently what it is trading at, since we are seeing since the end of March, somewhere on 31st of March, they were near those levels. Again, back to those levels as well that we've seen coming in the last couple of sessions as well. Let's keep an eye out on the oil prices. WTI crude oil prices also trading with just mild move coming in on the positive side, but nothing exciting for WTI crude oil prices as well.
All right, then let's quickly look at the events that we need to keep an eye out for today. Now, we have, of course, we are in the thick of earnings season now, and back home we have HDFC Standard Life, we have Maruti Suzuki, we have Bajaj Finance and SBI Life that will be reporting their quarterly numbers today, and we will be tracking that very closely. In the corporate actions, we have the rights issue that will open for Som Distilleries, and we have Biocon that will be considering the issue of NCDs. And in the global cues, we have the US crude oil inventory number that will be coming out, and also we have some global earnings that's likely to come out today. We have Boeing, Meta, Hilton and Nomura that will be posting their quarterly numbers as of today, Winnie.
Okay, let's move on and get updated with all the global news flows that we have coming in this morning. And what we're seeing is US President Joe Biden has actually made his 2024 presidential bid official. Now, Biden said that he will seek a second White House term in 2024, a decision that will test whether Americans are ready to give the 80-year-old Democrat, already the oldest US president ever, another 4 years in office. Now, Biden made his announcement in a video release praised by his new campaign team, in which he declares it his job to defend American democracy. It opens the imagery from the Jan 6, 2021 attack on the U.S. Capitol by supporters of the former President Donald Trump. Now, Biden described Republican platforms as threat to Americans' freedom, vowing to fight efforts to limit women's health care, as well as cut social security ban books while blasting MAGA extremists. Now, Biden's age makes his re-election bid a historic and risky gamble for the Democratic Party, which faces a tough election map to hold the Senate in 2024 and is the minority in the House of Representatives now.
And the US consumer confidence has dropped to a 9-month low in April on the back of some pessimistic views on the economy that could fail into recession this year. A report shows that consumers are in fact turning sour, and expectations around the labor market will soon begin to soften. Moreover, inflation is still widespread and running well above the Federal Reserve's target.
And some of the earnings that Ankita highlighted previously as well. Key tech earnings take the center stage in the US as global's parent Alphabet delivers an earnings beat in the first quarter. And as the company continues in its efforts to cut costs, their revenue rose 3% on a year-on-year basis. Company has mired in a multi-quarter stretch of low single-digit revenue growth after nearly 2 decades of consistent expansion. Meanwhile, Microsoft too surpassed the street expectations on the top and bottom line. Net income surged 9% to $18.3 billion, and revenues also went up by 7% on a year-on-year basis.
An audio streaming service, Spotify, added 26 million active users for the quarter one, the largest ever user growth in the first quarter. The increase in users is the second largest quarterly net addition in its history, takes the company overall user base to 515 million for the quarter. Growth continued to stem from driven by higher reactivations, improved retention and marketing efficiencies.
And Pepsico too reported its Q1 numbers. Pepsico's Q1 revenue rose by 10% on a year-on-year basis. Meanwhile, the net income for the same period came in below $2 billion versus $4.2 billion figure reported in Q1 last year. The beverage business grew by 1% in terms of volumes, but the food segment declined by 3%, interestingly. Now, volumes were down by 2% across categories, but the prices went up to 16% in the past year as well.
And global apparel retailer Gap is planning to lay off more than 500 employees in an attempt to cut costs and increase efficiency. The exact number of job cuts remains unknown, but the reduction will be larger than 500 or so. The shares dropped about 6% and has taken a hit of more than 16% this year.
And staying with the sentiment check of the U.S. economy, some important comments coming in from the Treasury Secretary Janet Yellen that the government debt default would be a catastrophic for the economy, sparking mass unemployment, payment failures and interest rates rising into perpetuity. She believes that this could also lead to a mass layoff amid government officials, coupled with a steep decline in the credit markets.
And in the first phase of Operation Kaveri, 278 Indians have left the conflict zone of Sudan. Aboard INS Sumedha, MEA spokesperson Arindam Bakshi took to Twitter and shared the images of people from the Indian Navy patrol vessel. This operation was launched to help stranded Indians come back home safe from the violence and unrest in the region. Other countries like Saudi Arabia and France had already been taking initiatives to evacuate people from the conflicted zone.
And the DMK government in Tamil Nadu has put on hold a bill that was passed last week to allow 12-hour workday. The new labor codes pushed by the centre had also permitted companies to make their employees work for 4 days instead of 5. And it's not new to India as it has been in talks around the world as well. We break down the new legislation and what's happening globally on 12-hour workdays. Take a look.
The DMK government in Tamil Nadu has put on hold a bill that was passed last week. A bill that was to allow a 12-hour workday in the state. The government's move comes in the wake of protests by several political parties and labor unions. Only last week, that bill was passed by the DMK government in the Tamil Nadu Assembly. So what explains this kind of U-turn? And what is the controversy all about? Well, let's start by understanding what the controversial bill says. The Factories Amendment Act 2023 provides flexible working hours for employees across the state. This meant that employees could choose to work 12 hours a day instead of the mandatory 8 hours. This would have resulted in a 4-day work week for employees. This move was expected to boost industrial production in the state. And since the DMK government commands a majority in the state, it had passed that controversial bill through a voice vote. But the bill's passage has seen protests by labor unions and opposition political parties. They claim that the 12-hour work week, or work day, would lead to labor exploitation. The ruling DMK government, on the other hand, argues that the bill would lead to more industrial prosperity for the state. The Industries Minister, Tangam Tenarasu, has claimed that this move would create new employment opportunities, especially for women. Moreover, it is applicable only to certain sectors, like electronics industries, like non-leather shoemaking industries, and electronic clusters. Now, the 12-hour work per day is not a new idea. The new labor codes have been pushed by the centre. They too have permitted companies to make their employees work for 4 days instead of 5. This effectively would have led to employees working for 12 hours every day. Globally, that idea has found acceptance in multiple countries, particularly in Europe. Countries like Spain, Iceland, Ireland, among others, they've implemented a 4-day work week in one form or the other. But with Tamil Nadu's legislation now running into protests, that idea, over here at least, back home, seems to have few takers.
Well, with that, it's time for us to slip into a short break. Don't go anywhere. We go domestic after the break.
Welcome back, and you're watching Market Cafe on ET Now. Let's just look at what the Asian markets are doing this morning as well. And nothing exciting coming in, given the handover that we saw coming in from the US markets. Most of the Asian markets are trading lower as well. Let's start with the Hang Seng. That is extending its loss further as well, down 0.2% in trade. Okay. Seems like it's turned a bit into the positive side as well. Slight bit of a positive bias coming in for the Hang Seng over there. Shanghai, let's look at what that is doing. Shanghai too has turned positive this morning, keeping an eye out on that one as well. So mild gains that we're seeing coming in, again in terms of a recovery that we're seeing coming in, because slight bit of a recovery, at least in the Asian markets. They opened a bit in the red, but yes, they started trading in the green. Let's look at what the Nykaa is doing as well. Nykaa is seems like it's trading in the red as of now as well, down 0.4% in trade, while Kospi is trading in the green, up 0.3% approximately in trade as well. Even when you look at the ASX 200, just flattish moves that is coming in for ASX 200 as well. Keep an eye out on that one. SGX Nifty is also indicating a bit of a muted start. Let's keep an eye out on that, how that works out, because we do have a lot of companies that reported their numbers post-market hours in terms of Nifty, like Tata Consumer, Bajaj Auto. We'll have a lot of Nifty companies today as well. So maybe that could be some bit of an impact in stock-specific move for the Indian markets. But as of now, expected to see a muted start for the D Street. Welcome back, and you're watching Market Cafe on ET Now. Let's just talk about Tata Consumers. Tata Consumers reported their Q4 FY23 numbers. And when you look at the numbers, we're seeing overall a strong beat is coming in, especially on the margins and profits of the company, while revenue of the company came in line with estimates. Key highlights: one, we're seeing a double-digit growth aided by the food business. Food business saw a growth of 26%. We were expecting a more than 20% growth, so yes, that was there as well. Volume growth for the food business came in at 8% as well. One concern that comes in is that in the India beverage business, that has actually lost some market share by around 113 basis points. So keeping an eye out on that, though the India beverages business saw a growth of 8%, volume growth of 3% as well. And what the company also highlights that premium segment recorded a growth in the India beverage business, while the economic segment was something that was impacted by the rural slowdown of the company, is what the company noticed. Now, other than that, in terms of margins have remained flat on a year-on-year basis, better than what we were expecting. So surely margins came in as a bit of a positive on that front as well. Other than that, commentary is coming in from the management, where they are saying that they are seeing a sequential improvement in terms of the international business margin, which is expected to normalize by Q1 FY24 as well. Other than that, they are also saying early signs of green shoots are seen for the branded tea business. They remain cautiously optimistic on the view going forward as well, and they have gained market share in salt despite the pricing actions that they've taken. They continue to stay focused on driving profitable growth along with building the future-ready capabilities as well. So all in all, a good set of numbers as of now has come in from Tata Consumers.
All right, then good set of numbers from Tata Consumers, and we'll move on to automaker Bajaj Auto, that has beat the analyst estimates with its Q4 results. Now, its revenue jumped 11.6% on a year-on-year basis, but the net profit declined by 2.5%. My colleague Shrishti Sharma, who tracks the sector closely, is here with all the number crunching. Over to you, Shrishti.
Well, a great set being reported by Bajaj Auto this time around. A surprise coming in on the revenue, EBITDA as well as the margin front, while the profit was in line to the ET Now estimates. A sequential drop of 4.5% is what we saw happening, wherein the top line being reported at 8,905 crores, EBITDA at 1,717 crores, not very far from its all-time high levels sequentially, and the margins also saw an improvement of 200 basis points sequentially, and 19.3 is the number on that front. Talking of profits, 1,433 crores being reported by the company, and clearly the domestic sales as well as the three-wheeler segment did help the numbers this time around, and exports, as we know, have been the biggest drag. But the company do mention that the price realization and the material cost held flat on a sequential basis, and it was totally the favorable product mix that saw a slight uptick and held the numbers. Overall, the market share holding steady in the international markets. So commentary on that is the key to watch. And other than that, if we look at all in all, a good set by Bajaj Auto this time around, and the stock is already near its 52-week high levels.
Surely that's going to be interesting to watch out, because Bajaj Auto, good set of numbers, already near its 52-week high. And when you talk about the brokerage notes that have come in this morning for Bajaj Auto, positive notes are coming in from brokerages as well. Morgan Stanley is maintaining an overweight rating given a target price of actually they've upped their target price to 5,063 rupees per share. They're also raising their EPS estimates by 8% for FY24. Recovery in exports is something that they're keeping an eye out on, but they're highlighting that the better mix drove the EBITDA for the company. So keep an eye out on that. Industry recovery, triumph, as well as EV win is an option value for Bajaj Auto. That's the word coming in from Morgan Stanley. Now let's move on, talk about JP Morgan. They too are maintaining an overweight rating given a target price of 5,150 rupees per share. They're highlighting the EV volume momentum can be a re-rating trigger for Bajaj Auto. They said do not wait for all catalysts to play out, but yes, export wholesale trailed retails for the 15 months as well. They have raised their FY24, FY25 expected EPS by 4 to 5% to factor in the margin beat that we saw in this quarter for Bajaj Auto as well. An increase in valuation multiple to 18 times of PE is what they are doing. So yes, two positive notes. Both of them have raised their EPS estimates for Bajaj Auto as well. We could see a positive move this morning for Bajaj Auto.
All right, then moving on to the big acquisition by Ipca. Ipca's acquisition of Unichem Street will eye company's financials in the quarters to come, and how both companies stand to benefit from the production and supply synergies. Let's bring in my colleague Shrishti, who has the key takeaways from Ipca's conference call. Over to you, Shrishti.
Well, as we know that the Ipca Unichem Lab deal didn't get a thumbs up from the investor community, where they were finding the valuations to be expensive and a bit on the higher side, and the stock was under pressure. In addressing this concern, Ipca Lab management held a con call wherein they did give a guidance on the Unichem Labs business over the next 2 years, where they are targeting the EBITDA to be around 300 crores in overall sales in the next 2 years. And do remember that FY22 EBITDA was at 72 crores. So quite an aggressive target being set out there. And onto the overall turnover, or the top line, is being the target has been set to be near around 1700 to 1800 crores for the Unichem Lab business. Onto the rationale that why Ipca Labs has acquired Unichem Labs at such a expensive valuation. So they highlight that 2500 to 3000 crores of assets are already available with Unichem, as well as in the past 5 years, Unichem Lab was the best deal when they were actually planning to go for an inorganic expansion. They also highlight that the order of the Unichem has started building up from Q4 FY23, as well as they are also looking to monetize Unichem's Jogeshwari property, and some value unlocking is also pending, and there's also a possibility of Ipca to unlock 275 crores in GST dues from Unichem. So all of these 4 to 5 points is what the company highlighted, that why Ipca Labs has gone ahead and acquired Unichem Labs. And onto the business front, they do believe that the focus will be clearly on expanding the US margins, as well as they also see that Unichem's raw material required could be fulfilled by Ipca. So these were the synergy benefits that the company highlighted, and they were actually addressing the concerns of the investors. Back to you.
Thank you so much for that, Shrishti. But Ipca Laboratory is eyeing stake in Unichem, like Shrishti mentioned. So let's go across and listen in to what the management also had to say about this. What is their view coming in here to this? Here, let's hear it to this snippet.
A lot of companies are facing headwind in US, and Unichem has fantastic track record on regulatory compliances in past. And looking at that and looking into the current business environment, and it appears that we should be able to comfortably achieve almost around 15 to 17% kind of growth in next 2-3 years very comfortably. They also have significant capacities which are available for executions and all. And Unichem has, I do agree that Unichem has higher overheads. We will have to look into and more critically on those, and also critically see that how can we optimize the operations, and cost optimizations can be done. As far as their API facilities are concerned, I think as far as their formulation facilities are concerned, they are excellent facilities are there. As far as API facilities are concerned, their scales are smaller today, and the operating costs are higher because of lower scales and all.
Well, with that, it's time to slip into a short break. Don't go anywhere. We get you all the stock-specific action on the other side.
Welcome back, and you're watching Market Cafe on ET. Now let's talk about ITC and VST Industries. Now, VST Industries actually last evening reported their numbers. It was a weak set of numbers that was reported by VST Industries. When you look at it, there was an inferior sales mix that has come in. Sharp inflation in commodities cost is something that was a drag on the profitability of VST Industries. Gross margins of the company also contracted owing to the steep inflation in the cigarette paper, as well as filter costs on the back of the global shortages that we saw coming in there as well. Other than that, there was distressed situation in UP and Bihar due to the shortage of rainfall, which was a key market for VST Industries, obviously. So yes, that weakness in VST Industries was on the back of all these situations as well. And obviously, there is a witness of a steep volume decline in the cigarette business, is what analysts are estimating as well. Now, the estimate they've come in, analysts are highlighting in terms of volume decline is around 10 to 11%, keeping an eye out on that. Now, because of this weak number, because of these issues that are in terms of the inflation, inflation, margin contraction. Obviously, ITC cigarette business could also see an impact coming in, and ITC, what analysts are highlighting, that maybe there is a market share loss to ITC as well. So that's why we're keeping ITC also in focus on the back of VST Industries numbers. Though VST Industry expects an industry volume growth of 7 to 10% in FY24 versus a flat growth in FY23. On the back of VST Industries numbers, let's keep an eye out on what VST Industry is doing as well as ITC, because analysts are assuming a market share loss for ITC.
Right, a market share lost for ITC then, and moving on to Nykaa. That is one of the stocks that used to be the darling in the fintech space on the back of its profitability. And that has been lagging this year, even while its peers have bounced back from the lows. Now, why are the investors giving cold shoulder to this retail beauty platform major? Well, my colleague Somit is joining us to explain the details. Over to you, Somit.
Well, if you see the new age of fintech companies, all of them have bounced back from the 52-week lows, be it Policybazaar, Paytm, Zomato, Delivery or Car Trade. Now, they have bounced back in the range of around 12 to 59%. The highest bounce back we have seen is in Policybazaar, that is PB Fintech. But Nykaa is one stock that has been continuously lagging the street, hitting 52-week lows every day. Now, what are the investor concerns because of which we are seeing such kind of underperformance in Nykaa? Firstly is the fact that there has been a high employee churn. Nearly 5 senior executives exited the company in March 2023. Before that, the company secretary exited from the company. CFO and CTO also resigned in November 2022, while the private label CEO also resigned from the company in August 2022. So this is the number one concern. The second is the fourth quarter update was mixed kind of. Now, if you see, there was a healthy growth in the beauty segment. In fact, the fourth quarter beauty sales were at similar levels compared to the 9th month sales, but it is the fashion segment that has been ailing the stock price, because if you see, the fashion sales growth had moderated and investors are still not clear on the strategy of how Nykaa is planning to ramp up this segment going forward. Along with this, given the meteoric rise in Nykaa's financials, a lot of competitors have also taken interest in this segment, be it Myntra or Ajio, who have increased their assortment and advertisement spends. Reliance Retail has also entered the beauty segment by launching Tira. Tata Group through Tata Click is also eyeing this opportunity, while Shoppers Stop has also unveiled the launch of SS Beauty stores going forward. Now, the bonus issues saga that had happened earlier in 2022. Now, the share bonus was around the lockup expiry, and this has negatively surprised the investors given the timing, and this has consistently been an overhang on the share prices. Along with this, higher investments is also one concern, because if you see, with rising investments in retail, B2B and own brands, there are investor concerns on increasing capital intensity, because Nykaa needs to build more warehouses, increase their inventory levels, extend credit spends on retail stores. So this is one of the concerns ailing investors. Supply pressure is also one of the reasons why the share prices have been lagging, because if you see, there has been a non-stop supply in stock, which has also weighed on the share prices of the large pre-IPO shareholders. Nearly one third of them have fully exited the counter so far, but there are still many more investors who are invested in Nykaa, and investors are worried that they might also exit going forward. And also, there is a slowdown worry that has been ailing the share prices, because if you see, there are concerns on urban demand arising due to factors like high base and slowdown in the IT hiring that we have been seeing. And data is also suggesting that on a YY basis, there has been some slowdown in app downloads, especially in Nykaa.
Nykaa surely is one we're keeping an eye out on, Somit, but IGL is also going to be in focus, as IGL has actually bagged a PNGRB authorization key NCR region order. What does this mean for the company? How much has that order been coming in, Somit?
So if I sum up the PNGRB order, what it says is that in the Greater Noida and Noida region, IGL will continue to supply gas to its users. So there is no change in that front. In Faridabad, they have given one part of the region to IGL, while the second part has been given to Adani Total Gas. In Gurugram, one part again has been given to IGL, while another part has been given to Haryana Gas. So what are analysts saying out of this is that the authorization has been a long-standing issue, and given the fact that PNGRB has taken an effort to resolve this is positive, but there might not be much financial benefit coming out of this, because currently, if you see, IGL will stand to lose the trading gains that it was making, around 36 crore annually, that is around 2.5% of its net profit. So this will go away from the company, but there could be some volume upside, but again there could be competition also in these areas. So financial benefit at this moment might not be too high for IGL post the PNGRB order that we have seen.
All right, then moving on, auto giant Maruti Suzuki is set to report its Q4 earnings report. Now, the street expects price hikes to aid margins. Let's go across to my colleague Shrishti Sharma, who will tell us more on that.
Yes, we all know that the passenger vehicle sales have been holding steady. Similar is the like of Maruti Suzuki. And this time around in the earnings, the key thing to watch out for will be the margins of the company. Because last quarter, the company reported a EBITDA margin of 9.8%. And this time around, we are expecting a number at 10.6%. And if 10% mark is surpassed, then the company will report its margin above 10% after Q2 FY21 quarter. So a key thing will be to watch out for is the margin front. Talking about the volume growth, this time around it was a growth of 10.5% on a sequential basis. The realization is expected to be up 3% on a quarter-on-quarter basis. And let's talk about the number front. Revenue is expected to show a jump of 12% on a sequential basis at 32,529 crores is our expectation. EBITDA is expected to show a growth of 21.5% at 3,441 crores. Margins, like I told you, 10.6% is our expectation, up from 9.8% last quarter, and the profit jump of 6.5% is what we are expecting at 2,502 crores. So these are the expectations from Maruti Suzuki. Definitely there has been an improvement in the product mix, although the SUV share was almost flat, but the uptick in the margin, the factors are coming up from the likes of benefits due to the lower RM cost, and operating leverage will also play its role. But other than that, onto some of the drags, then the exports saw a bit of a sequential decline, and the Auto Expo expense back in January will also play heavy onto the marketing expense is what we believe. So these are the expectations from Maruti Suzuki. A steady set this time around. Definitely look out for margins, but we on the commentary front, we'll look out for commentary onto the initial signs of the demand slowdown is what all these dealers are highlighting, and the view on the increase in the supply challenges of late, as well as how the response for some of the recent launches of Maruti Suzuki. So all eyes on Maruti Suzuki results.
Keeping an eye on Maruti Suzuki's Q4 numbers, but Gujarat government has actually announced a new criteria for dividend distribution and bonus shares for its state public sector undertakings. Now, which include listed companies are there in this? What does this mean for these shareholders? Somit is again here with us to give us a detailed analysis on what will this mean for the companies and which are these companies that will be it. Somit?
Well, companies like GSFC, JNFC, Gujarat Gas, GSPL, Gujarat Alkalis, Gujarat Industries Power and GMDC. So these are the 7 companies that would be in focus because Gujarat state government has directed these companies that they'll have to give a dividend of at least 30% of their net profit or 5% of net worth, whichever is higher going forward. They'll have to do a buyback if their net worth is at least 2,000 crore rupees and they have a cash of more than 1,000 crore rupees in their books. They'll have to also issue a bonus shares if the reserve capital is more than 10 times their equity share capital, and they'll also have to go ahead and do a stock split if the current market price or the book value of the share price is more than 50 times its face value. Now these are the directives given by the government to these companies. So based on the data collected by our team on the dividend payout, net worth, free reserves, their cash balance, what we are understanding at this moment is that GNFC is the only stock which will be eligible to conduct a buyback going forward. All companies in the list, all the 7 companies that I mentioned are eligible to issue bonus shares going forward, while only GSPL and Gujarat Industries of the 7 companies cannot do a stock split at this moment, but all the other 5 companies can do a stock split. And when it comes to dividend payout, we are expecting at least the dividend payout to be double for GSFC, GNFC, GSPL, Gujarat Alkalis and Gujarat Gas, while for Gujarat Industries Power, we are expecting the dividend payout to increase by at least 800 basis points, while for GMDC, we are expecting the dividend payout to remain largely stable compared to what the company did in the last financial year.
Right, thank you for those details, Somit. And we'll move on. Bajaj Finance will report its Q4 numbers today. A slight moderation in margins and an uptick in NII is on the cards. Let's go across to Vamakshi for more details on what the street is penciling in. Over to you, Vamakshi.
Well, a good set of numbers is what we're expecting from Bajaj Finance in the fourth quarter of FY23. Net interest income is expected to see an uptick of nearly 29% on a year-on-year basis at nearly 6,186 crores. PPOP, that is the pre-provisioning operating profit, is also expected to surge higher by 29% on a year-on-year basis to 5,110 crores. PAT is also expected to see an uptick of nearly 23% on a year-on-year basis, and another positive is that the provisions are also expected to decline sequentially from 841 crores to 829 crores. So largely we're expecting a good quarter as far as growth and profitability is concerned. Now net interest income year-on-year momentum is also expected to be strong given the healthy AUM trends, controlled OPEX as well as better operating income could in turn aid the BPOP as we see, and apart from that we're expecting a slight moderation to come in terms of margins, and on the other hand we're also expecting that credit costs are expected to moderate. Improving collections could be a tailwind for asset quality as well. So largely those were the expectations, but there is some important factors that you should watch out for. That would be the ability to sustain growth momentum given the rising competition in the space from existing players as well as the entry of geofinancial services, NIM and business outlook, as well as commentary on introduction of new products and the company's ability to scale them up. So all in all, we're expecting a good set of numbers to come in from Bajaj Finance.
For that, Vamakshi, but staying with the insurance players and talking actually about the finance insurance side now, SBI Life will be reporting, actually HDFC Life will be reporting its numbers. What are the numbers that we are expecting in terms of insurance players? Let's go across to Harsh and listen in.
Expected to grow the gross premium income at 25% year on year, very impressive. 18,000 crore odd is where that number is expected to come in. PAT expected to come in a solid 60% higher on a year on year basis. 580 crore is where that number is expected to be. VNB expected to grow by 20% and margins expected to expand. 29% is where the margins are expected to be, roughly a 2% expansion sequentially as well. What do you expect in terms of the broader commentary? Well, we're expecting stronger trends coming in from non-par on the back of some of those tax changes that have come through. New product launch announcements again on for the same reason in FY24 and how that pipeline will play out and the expectations of management there. Higher than expected VNB growth already expected in this particular quarter, and margin expansion is expected to be strong. Also, the other monitorable will be the persistency ratio. On SBI Life, we're expecting to see gross premium income grow a solid 23% year on year. 21,500 odd crore is where that number is expected. PAT expected to grow by a solid 25%. 830 crore odd is where that number is expected to come in. VNB as well as margins expected to remain largely stable. VNB expected up 30% year on year, 1450 crore odd, and VNB margins expected to be solid 29%. Now, SBI Life continues to take advantage of its geographical reach as well as distribution muscle to aid growth is what we expect. Largely the new business premiums are expected to sustain. Margins and VNB are expected to hold up healthily, and of course changing regulations with regard to the impact of that, especially on the tax regulation front, is to be expected. SBI Life's non-par machine is expected to get tested in this particular quarter, as well as new product line also on the investor radar going forward.
And with that, Vinny and I will take your leave. It's time to wind down on the show. Thank you so much for tuning in. Don't go anywhere. The market is up next.